Hello, welcome to Strictly Money. I'm your host, Saijal Patel. The Bank of Canada hiked borrowing costs once again in the face of a resilient economy. This despite a downward trend in inflation. The benchmark interest rate now stands at 5%. Joining me now with his thoughts on the impact this could ultimately have on the Canadian economy and your investments is Alfred Lee, investment strategist with BMO Asset Management. Alfred, great to have you on.
Thanks for having me.
So until recently, Alfred, a lot of economists and strategists thought that they'd actually stay on the sidelines, but it looks like Bank of Canada seems to think that our economy can withstand higher rates. Do you think they're right?
Well, it seems like it. I mean, as you mentioned, we got another quarter point rate hike by the Bank of Canada today, which didn't really come as a surprise given that the market was pricing in roughly about a 60% chance that we're going to get a rate hike. But I think, this is a clear indication that the Bank of Canada has transitioned to a policy that is going to be data dependent, even though we've got two consecutive meetings in which we raised rates. That doesn't necessarily mean that we're moving back towards this aggressive shift towards aggressive tightening. I think, as I mentioned, it's going to be a little bit more data dependent. I think Canada has been very fortunate in the sense that we've been aggressively hiking rates over the last year, but we haven't really exposed a lot of systemic risk in the system. So similar to what we saw with the UK with the pension plans back in last fall, more recently with the US and the regional banking crisis back in March, we haven't really seen any systemic shocks to our system. I think you got to credit the banking system in Canada for that. But I think that doesn't necessarily mean that we don't have our own concerns as well. I mean, household debt is still at record levels.
Yeah.
I think every incremental move is going to be, even more felt by the Canadian consumer now. So I think, uh, the good thing is that from the Bank of Canada's point of view, with every incremental move, that means there's going to be less discretionary spending for the Canadian consumer, which hopefully we're going to see a lot of those discretionary service items start to come down, hopefully in the next 3 to 6 months.
Yeah, it's interesting that you say that, Alfred, because I just read a report that says half of Canadians say that they're about $200 away or less from not being able to pay their bills at the end of the month. I've seen this data time and time again. But yet, consumer spending seems to be resilient. The labor market is resilient. What do you make of this? Is there a discrepancy?
I think there's a few things going on. I mean, I think a lot of the people, in terms of their mortgages, they've, only a few have refinanced over the last year or so. But, as you know, in Canada, the mortgages aren't as long term as we have in the US. So what that means is that over the next couple of years, we're going to see a lot of these mortgages kind of reset to higher rates, which is going to have an impact on that discretionary spending. So, as I mentioned, with household debt still at record levels, but once we see some of those mortgages kind of refinance to higher rates, that's potentially when we see a lot of that discretionary spending fall off. And keep in mind, I think, over the last 3 years, obviously with the lockdowns and everything, people have been cooped up. And I think the first thing that everybody wanted to do was go out to the
Yeah.
favorite restaurants and go and take a lot of these vacations that we haven't been able to do so. So I think that's been the impact. A lot of that revenge buying, as they like to call it.
Alfred, you talked about mortgages. Now, mortgage costs are contributing to the inflation figures, even though, like I said, it is coming down. This does mean a lot of more pain for mortgage holders. Ones that have fixed, and that's they might be up for renewal at the end of the year, and also the variable mortgage holders. What do you think this could mean for the economy?
Well, in terms of the real estate market, I think the real estate market has been surprisingly very resilient over the last year. So as we've seen these interest rate hikes, the real estate market, especially in key areas like Toronto, we haven't really seen those housing prices fall off. I mean, they
Mhm.
did drop a little bit over the last, couple of months, but as interest rates have leveled off now, we're starting to see a lot of multiple bids in certain areas. And I think that is due to, supply shortages, for example. There's not a lot of new housing permits being given. So I think there is going to be a supply shortage. So I think the real estate market here is very different. And when you add on top of that, 500 new, immigrants coming into Canada over the next year, I think there's going to be more resiliency in the real estate market in key areas.
Yeah, definitely. When you think about a million or so is the target for immigration. We know that it has to match the housing policies, and we're not seeing that. We're going to take a quick commercial break. We'll continue this conversation when we come back. Welcome back. Alfred, what do you think Tiff Macklem is looking for now? Because he has raised rates, consistently. It doesn't seem to have worked too much. And in fact, in some ways, inflation is contributing, or the higher rates are contributing to more inflation, at least when you look at things like mortgage costs. So, what do you think he's watching for?
I think, a lot of the metrics such as services, for example, on the services front, I think that's where a lot of the inflation has been a lot more resilient. So when you look at goods, I mean, goods inflation has come down significantly. I think headline inflation has come a long way as well. So, when you look at inflation in terms of CPI, we got the most recent CPI print by Canada, which came in at 3.4%. Next week, we're going to get another CPI print. So I think headline has come down significantly. But I think in the services front, that's where it's been a little bit more sticky. So as I mentioned before, I think as a lot of people refinance, their mortgage rates and, mortgage payments, we've heard in certain scenarios are going to double, if not triple in some cases. The first items that you're likely going to cut is a lot of those, discretionary service items. So things like, as I mentioned before, travel or, restaurants. We're starting to see those numbers start to come off in the US. The US recently, or just this morning, reported their CPI, and this is where the discretionary items have started to fall off. So hopefully, we're going to start to see that in Canada, and they think that's what they're going to be focused on.
Do you think that they'll sit on the sidelines now for a while?
I think it's going to be a lot more data dependent. I mean,
Yeah,
we
you
did a
mentioned.
lot of aggressive rate hikes over the last year. As you mentioned, they've sat on the sidelines until, well, after the January meeting. I think that's the right policy. I mean, usually it takes 18 to 24 months for higher rates to work its way through the system. I mean, theoretically, that means, the first rate hikes that we saw a year ago haven't really fully been baked into the economy. So I think, taking this wait and see approach, I think is the right idea. We've seen inflation headline come down quite significantly. So I think waiting and seeing and taking an approach that's more data dependent, I think is the right approach at this time.
Alfred, I want to get your thoughts on something that I've been paying attention to, and I tend to be quite vocal about, is that you have fiscal policy and you have monetary policy to affect inflation as well as the economy, and I just feel like there's so much focus on monetary policy, and a lot of the burden is on the Bank of Canada or say the Federal Reserve. Do you think more could be done on the fiscal side?
Potentially. I mean, just in terms of the fiscal side, it seems like, governments are more focused on spending at the current time, which obviously is going to be a lot more inflationary. The Bank of Canada can only affect monetary policy, obviously. So, as a result of that, I think, what has been done so far has been more focused on monetary policy. I think fiscal has been there to support the population in case we run into any kind of hardship. But I think the focus obviously has been on monetary policy. So far, just judging by headline inflation, it has been some very effective, in my opinion.
Okay. So let's talk about the markets then. How have they been reacting to news like this? Overall, it seems like it's been fairly resilient, but I want to get your thoughts, and also whether it is pricing in some type of recession, even if it's a soft landing.
Yeah, so far, I mean, the markets have definitely, it's been a very different story in 2022. Let's put it
Mhm.
that way.
Mhm.
I think, coming into the year, the expectation was for the Fed and the Bank of Canada, slow down in terms of its rate hikes, which we have seen. We saw, as we mentioned, the Bank of Canada did take a pause after the January meeting. We saw the Fed do the same at its recent meeting as well. So I think that's been great for markets. I think a more stable interest rate environment has definitely been good for risk assets. That's why we've been seeing, a lot of the, fixed income market has come back, the equity market has come back as well. But I think where we're going to see potential tailwinds is, sectors like technology, for example, which obviously was hit pretty hard last year due to interest rates going higher, and long duration sectors like technology are obviously going to benefit in this type of environment where interest rates are going to be a lot more stable, not to mention all the buzz around AI. That's going to be a potential tailwind for technology over the next 3 to 6 months, potentially.
Yeah, that'll be it'll be very interesting, and I definitely want to dive into a little bit more of your thoughts when it comes to sort of portfolio management and where you see some themes. In terms of rate hikes, you don't see any, or sorry, cuts. You don't see anything soon.
No, I don't think so. I mean, the market was initially pricing in some rate cuts at the end of the year, which I don't see how that could happen. I mean, unless we got a recession, I don't see rate cuts happening anytime soon. I mean, the
Okay.
market is pricing in now rate cuts after 2024. I think we're going to remain in an environment where interest rates are going to remain higher for a longer period of time.
Okay. We'll take another break. We'll be right back. Welcome back. I'm here with Alfred Lee of BMO Asset Management. We touched on portfolios and investing, Alfred. So let's talk about this a little bit more. What does it mean for someone who has perhaps a balanced asset allocation, meaning equities and exposure to fixed income? What would you say, or what would you expect from that type of portfolio right now?
I think the balanced portfolio is going to be a lot better position than it was, let's say, a year ago.
Yeah.
A year ago, obviously, in 2022, was one of those rare years where a balanced portfolio did not work. And the reason why is because we spent the last 10 years inflating assets through QE and zero interest rate policies. Last year, we did the opposite. So it's no surprise that balanced portfolios did not work. But I think going forward, I think the benefit of balanced portfolios is that when you look at fixed income, in the last 10 years, fixed income did not provide any yield. It did provide some stability until it didn't work in 2022. But I think now with interest rates more normalized, I think fixed income is back. I think in terms of the balanced portfolio, that fixed income portion is going to provide not only yield, but also that ballast to a portfolio as well. So I think balanced portfolios are going to be very well positioned going forward.
Okay. What about investors who are investing, say, a 4 to 5 year time horizon, so a longer term horizon? How much exposure, Alfred, should they have, say, to the broad Canadian index versus the S&P versus Nasdaq, versus international? Walk us through what you're thinking about.
Yeah, so I think it really depends on their time horizon.
Hmm.
Obviously, if they need income over the next 2 years, you probably need a little bit more cash. But if you are looking further out, I think areas that we do like are the U.S., for example, just given technology is the one of the main exposures, and we do believe that technology is going to be one of the drivers going forward. I do think things like factor-based ETFs are going to be a good tool for investors. For example, focusing on the quality factor. I think if we remain in an environment where interest rates are going to be a lot higher, focusing on those quality companies that have stronger balance sheets or that are going to be a lot more resilient and carry less debt load, I think that's a good way to position the portfolio going forward.
Yeah, let's talk about tech for a little bit, because what we saw last year, Alfred, at least from what I could see, is there was a lot of balance sheet cleaning up, because it had got ahead of itself. And so, do you, like you said, so you see tailwind in this sector overall, or and also, do you think that there are certain ones that are going to benefit from, say, AI, like you mentioned, because that's certainly a hot trend that a lot of people are paying attention to now.
Yeah, no, I think so. I think you raise a good point. I think when you look at last year in 2022, we saw interest rates come up significantly, which was a huge headwind for technology. Unfortunately, I think last year, I think when you look at the entire sector, technology as a whole was sold indiscriminately. So when you look at a lot of the larger cap tech names, things like Google, Apple, Microsoft, those are cash rich
Hmm.
companies. I mean, those should not have sold off last year. To your point, I think a lot of the tech companies did see some balance sheet cleaning, but a lot of those larger tech names that are leading the charge this year, I think those are coming back just because they were oversold. But at the same time, As you mentioned, they are also the leaders in those AI innovation as well.
Do you think that the Canadian market will outperform the US market? There was a time where a lot of people did think that would happen, and it did for a while.
I think Yeah, so I think it really depends on, what happens with technology. I think, one of the things that are really undervalued right now is Canadian banks.
Mm,
Canadian
yeah.
banks, when you look at things from a valuation perspective, you haven't seen Canadian banks trade this cheap since 2020. These are the rare occasions when, banks are trading very cheap in terms of valuations. Dividends are very attractive. So it's a good buying opportunity in terms of Canadian banks. But in terms of long-term performance, as I mentioned before, I think that technology component in the U.S. I think is going to be a key tailwind for U.S. equities over the next 2 to 3 years.
The banks, you don't see any sort of systemic risks. They're well cushioned.
Yeah, it really depends. I mean, to your point, I think a lot of that, contingency capital has been put aside. So,
Yeah.
if the losses come in greater than that, then potentially there is going to be more of a sell-off. But as you mentioned, I mean, that capital has already been put aside. So if those loan losses actually come in less than that, that potentially is a catalyst for the Canadian banks.
Okay. Well, we'll take another break. We'll be right back. Welcome back. Alfred, we're on our last block. One of the obvious ways to get exposure to the market and be diversified are ETFs, as well as mutual funds. So I want to talk about this active versus passive investing debate. I recently learned about the SPIVA report, which is as you know put out by the S&P, and
Mhm.
it's a report that measures the performance of in this case, let's say it's the Canadian actively managed funds versus their respective benchmarks. This is something that you pay attention to. Can you just walk us through some of the high level conclusions that you've seen?
Sure. I mean, to your point, it's a report put out by the S&P. So it stands for S&P Index versus Active. So its name suggests, it's really just a long-term research report that's released on a regular basis, and it really just measures active managers against their relevant benchmarks. What it does find is that, usually indexes outperform in most areas. So it doesn't matter whether it's U.S. large cap or everything from small cap or to bonds. But there are percentages, or there are certain active managers that will outperform in certain environments. Having said all that, I think as I mentioned before, if we are in an environment where we are going to see interest rates remain higher for a longer period of time, I do think that that does open up the opportunity for active managers, especially those good analysts and a lot of portfolio managers that can look at a financial statement and
Hmm.
can see or unlock a lot of value by looking through those financial statements. So it is a good opportunity for active managers if the interest rates remain higher for a longer period of time.
Yeah, that makes sense. I mean, it makes sense if you suppose you want to buy a small cap stock or exposure to small caps that are undervalued, because that takes more analysis, or perhaps access to thinly traded markets. I think that makes sense as well.
Yeah, absolutely. I think in certain markets, like high yield, those are areas in which active managers have had a lot of opportunities, and just in terms of looking at inefficiencies in the market. And to your point, I mean, small cap as well, and also a lot of these new and innovative sectors or industries such as AI. I think when you have an active manager looking at those spaces and those new trends, that could definitely add a lot of value.
One of the challenges that I see, and one of the questions that I get, Alfred, from a lot of people, they're like, "There's just so many ETFs out there and funds out there. How do I pick? What's your advice to them? I mean, is it something that they just don't really have to think about, you know, fine tune and get into the details? Like if they just pick any sort of, benchmark index that's say exposed to the TSX, that's good enough? Or would you say there's certain specific things they should be looking at?
It depends on what kind of ETF you're looking at. I think if you are looking at traditional index-based ETFs, obviously cost is going to be one thing that you're going to be looking at,
Hmm.
but also just in terms of how that ETF gets that exposure. Is it buying the individual stocks or bonds, or is it getting it through synthetically? I mean, depending on what type of investor you are, the end result really depends on what you're looking for. But also on top of that, I think if you are looking at factor-based ETFs, you want to do a lot of due diligence just in terms of how that ETF is getting that exposure. There's a lot of factor-based ETFs that have very similar names, for example. So for things like low volatility, how we do our low volatility is going to be very different than another ETF provider. So what's suitable for the end investor? I think they need to do a lot of research, and obviously with ETF providers such as ourselves, we're always there to help as well.
Okay. We have 30 seconds left until the end of the show. As I said, lots of ETFs out there. Passive investors or passive investing is now kind of going into the active world and so on. Do you see a lot of consolidation in the space coming?
Uh, I just in terms of active and passive being used together, or
Just generally, yeah, with fund managers and ETFs.
I think so. I mean,
Yeah.
right now there is a lot of ETFs, as you mentioned. I think, a lot of those, larger ETF providers that are able to have a more complete product shelf,
Okay.
and are able to service the clients is going to perform well in this environment.
All right. We're out of time, Alfred, but always appreciate your time. Thanks so much.
Thanks for having me.
As I said, we're out of time, so we will see you here next week.